Hello traders, welcome back to the Forex Gig, where we dive deep into the tool that can help you make smarter trading decisions. In today's video, we are going to be talking about the morning breakout strategy. This strategy is designed to help you take advantage of the volatility that often occurs in the first hour of trading. By understanding how to identify key price movements and entry points, you can position yourself for potential profits. Stay tuned as we explore the essential components of this strategy, practical steps for implementing, and the tips for managing risks effectively. Make sure to watch until the end of the video to gain valuable insights that could enhance your trading approach. We start by understanding the morning breakout strategy. The morning breakout strategy focuses on capturing price movements that occurs shortly after the market opens. This strategy is based on the idea that the first hour of trading often sets the tone for the rest of the day. During this time, traders react to overnight news and economic data, leading to the increased volatility and potential trading opportunities. To effectively use this strategy, you need to identify the open range, which is typically defined as price movement during the first 30 minutes of trading. This range helps you understand where the market is consolidating before making a decisive move. This is an example. This is the open of today's candle. Let me use my vertical tool to explain to you the timing. This is the timing. This was when price opened for the day. This is the range before the day, the sideways movement before the tone of the market showed its hand. This is what it means. Once you have established the open range, you would look for breakouts. A breakout occurs when price moves above or below the low of the range. Let's look for a more sincere example where we see a strong range. Okay, let's use this as an example. Yes, this is the range before the open of the market. As you can see, this is the range. So we'd have to look for when price breaks out of the high or low of the range. When price broke out at this area was when we can decide to buy, or when it breaks below is when we decide to sell. Let's look for another example. We can also use the Asian range, but for this we'd have to spot the range by ourselves. Okay, this was the range before market opened. This little sideways movement before market opened and broke to the downside of the range. In this chart, you can see the candle closed below the open range of the chart. Let me remove this tool here. You see that price closed below the open range, and the closed price confirms that sellers are in control, and it suggests there is going to be a further downward movement in this trade. Conversely, if price closes above the open range of the chart, it shows that there will be a potential upward trend and it may begin to occur. Let's look for a bullish example. bear with me as I look for, or let's go to another chart. Let's look at Euro USD and we look for a bullish example. I would look for a bullish example. This is a bullish example. At this area was where market opened for the day. If you notice, there was a sideways movement before the open of the day, and price broke out of the high. This one happened it took a while before it happened. So let's look for a more significant example. Now this is a good example. When trade when the price opened at this area of the chart, price was consolidating before it broke out to the up direction, showing signs of higher price in the market. Price is going to go to the up direction. Understand these key components of the morning breakout strategy allows you to recognize potential trading opportunities early in the day. By monitoring price movements around the opening range, you can position yourself to take advantage of significant market shifts as they happen. Now let's see how we can trade using the morning breakout strategy. Now we understand this strategy, the fundamental of the morning breakout strategy. Let's discuss how we can trade using this effectively. This section will guide you through the practical steps to implement this strategy in your trading routine. First, you would need to set up your chart. It is recommended to use shorter time frames like your 15 minutes or your 5 minutes. But for this example, we'll use our 15 minutes. This time frame allows you to capture the rapid price movements that occur during the morning section. This is the 15 minutes and this is what we are going to use as an example. In the chart we mark the high and low of the opening range of the first 30 minutes of trading. We mark out the range of the first 15 minutes of trading. This is the area. The first 30 minutes of trading. When price opened, the first 30 minutes, we marked it out. This is the range. We visualize. The visual reference will help you identify potential breakout points. Next, focus on identifying entry points. You would want to enter the trade when price breaks above the high or below the low of the price range. When price breaks above the high of the price range or below the low of the price range, that was when we want to enter a trade. For a breakout above, this suggests strong buying interest, while for a breakout below, it shows strong selling interest. So the breakout above shows a strong buying interest, while the breakout below will show a strong selling interest. Like from this example here, breakout below shows a strong selling interest. For instance, if we see a candlestick close above the open price, when we see a candlestick close above the open price, we have this is a hint that price, or this is a signal that we have to enter a long position. And conversely, when price close below the opening range or low range, it signals a short position. Confirming this breakout with volume can also enhance your confidence in this trade. When you confirm it with the volume, when you want to enter and you see an increase in volume, yes, it shows that price is going to go towards, there's going to be a strong momentum in price towards the upside. In this example, for this down example, you can see the range, there was an increase in the volume, shows that there's going to be a strong selling pressure. Imagine a chart where you enter a long position after the breakout. Your stop loss should be placed below the open range low, providing a safe net if the market reverse unexpectedly. If you enter a trade at the breakout, your stop loss should be below the low of the range. Here is a good example. This is to safeguard you against any sudden reversal in price. Finally, consider setting a profit target based on your previous support or resistance level. You can aim for a previous support or resistance level when we want to set our take profit. This is a previous resistance level. Stop loss can be placed at this area. Stop loss can be placed at this previous area, this previous high, as the case may be. These are areas where we can set for our take profit levels. Or we can also decide to consider a risk to reward of 1:2. If we have a 1:2, I think we are okay to leave the chart. 1:2 is a standard risk to reward that we can always target. This means for every dollar you risk, you would make at least $2. This is how we can manage our trade. And let's not forget that we shouldn't risk more than 1% or 2% of our account per trade. By following these steps, setting up your chart correctly, identify entry points based on the breakout, managing your risks with stop loss order, and establish targets, you can effectively trade using the morning breakout strategy. Alright traders, you have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, share and subscribe, and turn on your notification bell so that you wouldn't miss out on more trading tips and strategy. Thank you for watching, and I will see you in the next video.